the role of the financial sector is, as you know, that is important to promote poverty eradication and also share prosperity. So that's sort of background, how the work of financial sector or fintech can contribute to reducing the poverty. So the World Bank is celebrating 75 years next year. So it's becoming a good-aged institution. But it comes with a lot of knowledge. As I mentioned, that we spend a lot of time. And also, it's not only financial institution lending money to the government, but also we produce a lot of knowledge. And also do a lot of research. So today, I'd like to spend next maybe half an hour or so based on our research and our thinking, and then we discuss how the digital divide affects financial inclusion, or rather digital dividends contribute to financial inclusion. I welcome any questions. I may not have all the answers, but I'd like to hear your views and challenges so that we can take those questions for next stage or next level of our research. So in 2016, the World Bank published a report called World Development Report titled Digital Dividends. Every year around this time, this year too, we publish World Development Reports, which sort of select a topic of interest and then also the direction of our institution. And they do a lot of analytical research around the topic. 2016 was digital development, digital dividends. Digital dividends means the benefit of digital development rather than digital divide. And the research shows that the digital development promotes, the internet, the digital development contributes to development. And then how the internet contributes development is mainly around inclusion, efficiency, and innovation. So for example, businesses benefit from increasing reducing the cost, more access to more information, and then also people get the job opportunities, increase productivity, and the government also benefit from the participation, for example, digital ID or the voting through internet. So the internet itself has a contribution to development. And if you look at the world map, the internet actually even more evenly spread than income. So if you look at China, it's much bigger than economic development. But also, if you look at Africa, in the middle, it has challenge, although it's much better off than economic development. So this gives us an idea of the internet actually spreading. But when we did the research, only 1.1 billion out of the total population had a high-speed internet, and then 32 billion was a user. So not everyone in the world didn't have luxury to use or access to high-speed internet and also use the internet. So that was the findings. But if you look at our enterprise survey, we also conduct the survey among firms, that more and more the firms use internet, as you can probably know on your experience. But this increase of the use of internet for their businesses is across board, depending on even low-income countries to high-income OECD countries. The comparison between 2006 to 2009 and then 2010 and 2014, across the board, the use of internet increases. But the type of usage is mostly email. Email is the dominant use of internet. But the point here is that firms are using and leveraging the availability of the internet. Now, about the financial sector. We know that the digital finance or access to financial services through digital means have a benefits. For example, that the digital finance promotes financial inclusion through digital payments. Payments is an entry point for financial system. Also, women's economic empowerment, and also the credit market, credit information, use of credit or different data to produce credit, measuring credit worthiness. Also, digital finance can increase efficiency, reducing the cost of financial transactions, and also conduct remotely without two parties do not meet each other. Just through internet, they can conduct and make settlements. Also, digital finance spurs financial innovation. Automation is one, data analytics, also innovative instruments and products can be developed on digital space. So the digital finance has a benefit. Now, this slide is one of the thinking slides that I'm trying to, when doing the research and putting different sources together, that I tried to figure out what we want to discuss here today. Now, on the left-hand side is we're talking about delivery of financial services. And then on the right-hand side is more consumers and access to financial services. And then digital and non-digital. The assignment for me today is what is the impacts of digital divide on financial inclusion or exclusion. And it was very difficult to answer. And it's also, we don't have much data around it. But what we know is that digital finance, or through digital means, can sort of bridge the gap of access to financial services. So for example, that the customers have a choice of accessing digital financial services. Financial services through means, typically mobile phones, can be dumb phone or smartphones, and then laptop or other devices. But that's digital space. But if you think about, say, Kuala Lumpur, that's norm. But 2 weeks ago, I was in Mindanao in the Philippines, and talking to the people using financial services, they don't necessarily have such luxury to use either smartphones or computer to have access to financial services. But still, they have there's many financial service providers, typically NGOs, microfinance institutions, cooperatives, and they are doing well. So on the right-hand side, there are demands for financial services. Financial services can be provided through digital means if the providers and also the users have devices to connect digitally. But that do not necessarily mean that they are excluded from financial services, or they are not excluded from financial services, or therefore they still have access to financial services, but a very rather traditional way, either cooperatives or even informal lenders. Now, also we need to distinguish the formal financial services or regulated financial services and unregulated or often illegal financial services. In that part of the world, the islands or even Philippines, the 5-6 is known sort of lending scheme, which is the 5 days, the lending, the 5 days, and then you have to pay additional 1 day worth as an interest. So it's more 20% interest. Now, then in the middle, digital means that there are different type of products in long-term finance or insurance products, and then lending products, credit, but also alternative finance to savings accounts, and then mostly often used product payments, also remittances. Remittances is also the form of payments. But to bridge two gaps, you need to have certain infrastructure. Infrastructure is first internet or mobile network, that sort of infrastructure that connects the two sides, the users and then service providers. Also financial infrastructures. It can be payment systems, can be credit information, credit reporting systems. Also the enabling environment in the legal regulatory framework that allows to connecting two entities to meet together. But measuring these in a digital or non-digital is not so clear-cut, so it's mixed. Now, we also know that as a condition, that when the World Bank conducts every 3 years the survey called Global Findex, we measure the level of financial inclusion across the countries. And we know that 85% of rich, 60% of the population have mobile phones, and then 79% of bottom 40% have mobile phones. And the gap is much bigger in Africa, especially Ethiopia, Mozambique, Tanzania, Zambia. The gap is more than 20%. So already there are gap between those who have access to mobile phones or digital channel, and then they don't. Also, there are gap between high-income countries and then low-income countries, especially use of mobile phones and the internet. 82% of adults in high-income countries have both mobile phones and access to the internet. And in developing countries, only 40% have access to both internet and mobile phones. So it's clearly there is a gap in accessing the internet infrastructures. So the World Bank, and in 2016, the World Bank and the CPMI, is the Committee on Payment and Market Infrastructure, which is part of a Bank for International Settlements. It's a standard setter, came up with the report called Payment Aspects of Financial Inclusion. What we did is to look at the key elements to promote access to financial services, especially payments, as an entry point of financial inclusion. And we call it transaction account. So we didn't distinguish a bank account or e-money account. So transaction account, sort of a general account that can receive payments, make payments, and also store value. So that's the definition of transaction accounts. To promote the transaction accounts, or access to transaction accounts, one, we need to have foundation, sort of bottom, the foundation, which is critical enablers, and also the catalytic pillars, which is delivery of the driver of access and the usage of transaction accounts. So as we discussed in the slides before, that the financial and ICT infrastructure is one of the key foundations. Without that, it's difficult to promote access to financial services through digital means especially. And also, legal and regulatory framework is critical enablers. Especially when you say legal and regulatory framework, it's so general, and you don't really appreciate what it means. But when you look at each step of reforms, then a simple thing like the KYC, does a regulation allow e-KYC? Many traditional AML/CFT regulation requires a wet signature or face-to-face. And the definition of face-to-face is often physical face-to-face. So customer has to come to a branch. But the digital world, you don't need that. So that kind of reform is needed. First understood and then needed. For example, electronic signature. Not all countries have electronic signature law. So the electronic signature cannot be recognized as a form of legal form of, say, contracts. So you need to have wet signature, which is also can be obstacles. And also recognizing financial services through digital means also requires legal or regulatory framework to enable them to be delivered. And being Malaysia or in this particular world in ASEAN, as you know that it's a thriving economies, you don't often think about this as a challenge. But if you go to other parts of the world, this is really simple solution, but it takes long to reform, and also it takes long to recognize this as a challenge. So it still is a challenge. And also the public and private sector commitment is important. Without commitment, it's very difficult to mobilize investment. It's very difficult to have a clear policy direction to reform financial inclusion or development of fintech. Organizing this kind of the fintech conference is also part of a commitment, which the private sector appreciates. So this commitment is really key. At the same time, dedicated, say, for example, product needs to be designed for that particular purposes. So if you go to, say, even accounts, if you regular accounts, many countries, banks in many countries still charges fees to opening, maintenance fees, checking fees, or issuing an ATM. Where I'm from, Japan, traditionally it was not the case. So it was shocking for me when I opened accounts in other countries. And then those things are also important elements, and also type of accounts. Nowadays, as you may have heard, that the basic deposit accounts or basic savings account, which often called no-frills accounts, allowed to be deployed, and then many poor have access to such account with in inexpensive way. And also the access point is important. As you know, that the branches, bank branches or financial institution branches are limited. So that now, over the last 10 years, we talk about a lot of use of agents. Agents is based on contract arrangement between financial institutions and the agent or outlet who can provide access points, either traditionally cash in and cash out, but they could play a much bigger role, for example, referral for credit. So those are important. And also awareness of consumers, also consumer awareness and also financial literacy is critical. And then leveraging recurring payments. Recurring payments often cross-border remittances, so those are coming in regularly at say once a month or twice a month, and also the government payment, social assistance. So taking advantage of these recurring payments is the way to push transaction accounts. The world made a progress in terms of access to basic transaction accounts, yet still 1.7 billion adults, 15 years old older, do not have transaction accounts. This is reality. And in this particular region, China, India, Philippines, Indonesia, these are countries, part of top 25 countries. Of course, they are large countries and by population, but they have challenges in accelerating the use of transaction accounts, opening transaction accounts. Now, the World Bank in 2015, we made a commitment. It's called the Universal Financial Access 2020. So use of access to accounts by virtually everyone by 2020, together with the other private sector and the public sector entities, which is challenging commitment. But we made a bold commitment. And this is so part of commitment. And then, for example, a private sector institution commit a certain number of accounts to be opened. And so that's what we are making progress. But still, only 69% of adults have accounts, so it's still challenging. But if you look at the data carefully, still there are opportunities, because even though they don't have a bank account or the transaction account, e-money accounts, but many of them have mobile phones. And as we discussed, that the mobile phone is that one of the sort of basic channel to access to digital financial services. So we still see opportunities. And then use of digital payments is also growing. And as you know, that in China, it's obvious that a lot of the e-money is used to promote also not only payments, but also now e-commerce space. And Thailand and Malaysia, these are also increasing. And also there are a lot of reforms on the payment systems to promote. But I think this is also a simple, boring table, but also the message is very interesting, because this tells us why we have challenges to promote digital financial services. So one, distance. Distance is interesting because if you talk about traditional financial services, even microfinance institutions, they mobilize staff to go and collect the payments, or access through agents or branches. They are limited. But the digital financial services can shorten the distance. So it's a challenge. Distance is shown as a challenge, but I see the opportunities for digital financial services. Cost, as we discussed earlier, that the internet helped a lot in terms of reducing cost in providing financial services, also other businesses as well. So the challenge, cost is a challenge, but also it's a flip side of it is that there's a huge opportunity for non-traditional, say fintech or other type of financial institution to address challenge of cost. Documentation. Yesterday, I believe we talked about the digital ID. ID is a key challenge. Producing an identification document is a challenge. 20 years ago, we talked about the letter from village head is sufficient enough to have open accounts. But nowadays, we have national ID. Where I live in now, Philippines, based in Philippines, we talk about creating national ID. Until last year, I was in Jakarta, Indonesia, so we talked about also the ID, national ID Indonesia, and which changed the landscape. So documentation is also something that digital finance can address, or digitization can address. Trust deficit, this is challenging. In general, trust in banking system has a history, and then often people tend to believe in cash, physical cash, rather than a digital form of money. So this is something still a challenge. And also this is the family, one account for family. It's another challenge. And but surprisingly, the last point is that only 3% adults says that we don't need accounts. So still massive opportunity to promote digital finance. Now, we spend a lot on accessing a transaction account, more cater for the payments. But we also recently conducted a study, a small study on financial inclusion beyond payments. And the purpose is to get to looking at the available data, which is global fintechs, and we note that many people actually save, but not necessarily in a financial institution. So this across the region. So EAP means East Asian Pacific, and ECA is Eastern Europe and Central Asia to Sub-Saharan Africa on the left. You see a lot of still people a lot save, and because many countries have traditional way of saving, either creating a group and then creating a savings among the group. Then we see this gap as an opportunity. How can we get these savings into a formal system? And so this digital savings account is, we sort of define digital savings account as the way to reach sort of access to savings account through digital means. Some banks or most of them actually partner with the non-banks, either fintech solutions or mobile phone companies or telecom companies to provide access. And often those legacy accounts is to use these digital channel to have access to the traditional savings accounts. Other financial institutions create own dedicated digital savings accounts for that purposes. But the function do not necessarily there's only savings, but there are different types of savings. We observed that some have a small lending product as well. And then the findings is that often it's primarily they're using either mobile phone or POS terminals, or they're combining the both. And the branches or the mobile phones or the agents can be used to access. And often the digital savings accounts are much cheaper or less costly to open, and also no minimum balance requirements. So this business model allows them to provide such type of products. And then we see this aggregation of digital savings account value chain, meaning that the banks may have a savings account, but the delivery can be outsourced to other type of institutions, fintech or mobile phones or other type of access to digital through digital channel. Also, products tailoring and customizations are made to cater certain segments of the population. And then also these leveraging existing digital financial system or service ecosystems, and meaning that agents through digital transaction accounts to consumers to develop enhanced financial capability through digital transaction accounts, also community access points. Now, since the World Bank provides the advice to the government or policy makers that these are the key messages to the policymakers, but enabling banking institutions to pursue digital saving partnership with non-bank entities. Often banking regulations are so rigid and the banks are sort of tied up with a strict way to do businesses. But there are opportunities to look at the regulations and allowing them to work with or form a partnership with different types of institutions within certain regulatory framework. Also harmonize consumer CDD or KYC standards. Often e-money and the bank accounts have different KYC requirements, and this can be a challenge. Also interoperability between the banks and non-bank e-money issuers. Often in the payment systems, e-money issuers or non-banks do not have access to payment systems, so that creates some obstacles. And for example, UK now non-banks have direct access to the RTGS, or real-time gross settlement systems operated by Bank of England. That's a very new way. And also the ACH have some ACHs allow non-banks to be part of memberships, and that's another reforms. So these are the things that liberalization can also promote access to digital financial services. Now, this is a quick way to look at how fintechs can also looking at micro and small medium enterprises. Because transaction accounts are often more targeted on individuals rather than firms. Now, we did the study, a quick study on the role of fintech to provide access to financial services in the Philippines. And as you know, that the banks often requires a lot of not only documentation, but many years of financial record. So for startups, it's really challenging to get the finances. And also the access to credit information is challenged. Now, in the Philippines, so when we look at challenges, the high cost to serve relative to revenue is a challenge. Lack of collateral was a challenge. Lack of credit information was a challenge, and lack of financial literacy skills and systems, and a difficulty in registration and verification. And then now more and more fintech companies are coming in to provide solutions. Also, the bank itself, the Bankers Association have come up with sort of a KYC platform to share also credit information sharing. So there are lots of competition, but there are big room for the fintech companies to play, especially to provide access to financial services in micro enterprises. Some example is that data. Data is very powerful, as you know, that yet handling data is often a challenge. Now, last year, the World Bank and IMF organized annual meetings. Around this time, we organized annual meetings. And last year, 2018, the annual meeting was held in Indonesia, Bali, Indonesia. At that time, we came up with the Bali Fintech Agenda, which is a 12 high-level policy elements to recognize the development of the fintech, and also the key messages for regulators to consider when they develop a regulatory framework. Now, as we said, we also recognize that still 1.7 billion adults do not have accounts. So for SDG, Sustainable Development Goals, how can we promote access to financial services for economic growth, and also the reducing poverty it's the sort of a background of this Bali Fintech Agenda. Also, we consider that the impacts on financial stability. So these are 4 key elements: is fostering enabling environment to harness opportunities, strengthening financial sector policy framework, address potential risks and improve resilience, and promote international collaboration. And around these themes that we came up with the 12 principles. For example, fintech embraced the fintech revolution, and we need to strengthen the institutional capacity as a regulator, also the communication with the stakeholders and the agencies. Also, enable new technology to enhance financial service providers, to facilitate and development of and also fair access to telecom internet infrastructures, also digital ID, that are the issues that we discussed already. For you, especially private sector, the colleagues, these are sort of norm in many ways. And probably you may have faced challenges in communicating with regulators. The bottom line is that, as you know, I'm speaking as an individual, not the World Bank, but regulators are lagging behind. Private sector always develop new ideas. But also the idea here is to how we regulators keep open-minded and then communicate with the stakeholders, private sector, and focusing on policy agenda. And also, competition is key. It's an open and free and then contestable market. Contestable is that easy to enter, easy to exit, and also the promoting financial inclusion and develop financial markets. We see a lot of developments in, especially financial market side, small products, and also this aggregation of the sort of value chain of the financial services. And these are really good development. A lot of fintech companies address inefficiency in the system. And also, the regulator should monitor developments. The regulatory sandbox and often used to create a space to develop and test the ideas. At the same time, regulators also learn from the experience. But the sandbox is not the only way to do that. There are different forms of engaging with the private sector. And then be flexible, adopt the regulatory framework that enables new solutions. At the same time, stability of the financial system. Why it's important? Because when crisis happens, the financial system is shocked. The poorest poor is often suffer most. So from financial stability is important for economic growth at the macro level. But from poverty, the institution who work on poverty, we also make sure that the financial system is sound and also resilient so that the poor do not get affected by the financial crisis. And also the modernized legal framework that I already discussed. And AML, CFT, regulatory RegTech is continue to be very important. And also they ensure the stability of a monetary financial system, as I mentioned, is important. And the exchange of knowledge and sustainable development of fintech solutions and the benefits, and also the exchange of knowledge not only between the private sector, but also with other regulators are critical. So these are the principles that the IMF and the World Bank took, and then communicate with the regulators and to promote fintech. But again, this is very high level, and for those who are actually in the running the fintech firms, probably it doesn't ring the bell. But it's also encourage you to think about those high level. Also, that helps you to communicate with the regulators. Thank you. Any questions? Yep. Oh, yeah. Thank you. This is a challenging task to read out questions and what can government regulators do? So I took a liberty of an easy question, to pick an easy question. But I think what can government regulators do to close the digital divide? I don't have an answer, but I think digital space, the World Bank also worked on the digital economy for Malaysia and also other Southeast Asian countries. And creating an ecosystem is a challenge. For example, we have a project called Greenback, which is a remittance project in East Malaysia, Sabah. And I work with the plantations, and we promote e-remittances. But access to internet or access to basic telecom infrastructure is not often a challenge. And so lack of internet infrastructure is a challenge, but it requires a huge investment. The benefit of internet or the digital development is that the marginal cost is very small. But the initial investment is huge. So that's really a challenge, and how government policy can be aligned to promote digital economy, and also the coverage of internet or access to mobile network is critical. Infrastructure development is critical, not only the huge role in the buildings, but also financial infrastructure, telecom infrastructure. These are really key elements. And the government have a certain role to play. Most of digital market players do not target B40, but it's as the customers. Sorry, I don't understand B40. Financial crime. So does easier access to more accounts lead to easier financial crime? How do you combat CFT? This is a challenge. So money laundering is that, so there are two things. The question is about the CTF, it's combating terrorist financing. Money laundering and terrorist financing are different things. First, money laundering, as you know, that it's you need a predicate offense. The money has to be dirty, right? So in the US until a few years ago, proceeds from marijuana selling was subject to money laundering. But now marijuana is legalized, so proceeds from marijuana is no longer subject to money laundering, right? So first, you need to have either corruption or what this predicate offense is there. So the challenge is that that's why the KYC is important. But the challenge of KYC or customer due diligence is that have a one criteria for every customer is a challenge, because that if you set a very high standard, financial system can be probably protected better, but also it creates challenge to exclude a lot of people, because that requirement is not be met well many, which creates incentives to create an underground or parallel banking system. So, and if the parallel banking system or underground system is large, then you can transfer money, transfer value. So it creates its own risk. So what the standard setter have done is that the risk-based approach. Risk-based approach is to set the criteria based on the risk of customer or type of transactions. But also this is a risk-based approach is easy to say but difficult to be done, no? So what is the risks? So you need to have certain risk criteria and then set different requirements. So what the Mexico did at the very beginning was that for prepaid card, you don't need to verify customer. You just identify I'm so and so, but you don't need to the customer do not show their ID to be verified. But because they cannot transfer money, they just add their money and make payments. But so they set the different criteria to do the certain risk profile and then a risk-based approach. That's how the still digital space, that's how it should apply. Terrorist financing is different. Terrorist financing, the source of money can be clean, but destination is act of terrorism. So for financial institution, it's very difficult to detect unless you know the destination. Certain NGOs or certain terrorist group has accounts, but it's difficult because you have to rely on intelligence and mostly commonly use the UN list, and but it's still a challenge. I think it can be digital or non-digital. I think challenge is still the same. But the money laundering, more data actually helps the regulators to detect anonymity or the outliers. So actually more data, more digital transactions are actually helping the system to prevent. In Southeast Asia, well, again, I don't have an answer. In Southeast Asia, globally, which country is leading the way in closing inequality gap through fintech? Inequality part, again, we don't have data, so we don't know. But we know that more say, for example, we're looking at this global Findex. Say Indonesia's progress is they have achieved quite a bit. I think 29% of adults to 36%, and 2017 data shows 49%. But Philippines, for example, known as GCash, smart money, have been known for a long time. But according to our data, it's been stagnated around 30%. Both countries, Indonesia is much 260 million population. Philippines is over 100 million population. Both are archipelago countries. I try to figure the answer to it, but I don't know. And partly because digital ID can help. National ID is helping. Also, the vibrant fintech community is also, Gojek and in particular. So I think enabling environment, also the community, fintech communities, and also government initiative, it contributes to a lot in terms of closing the gap. But what we didn't discuss, and what I don't know, is that whether the fintech or digital divide creates certain equality. So for example, for those who enjoy fintech services, say P2P lending, crowdfunding, what I don't know is that those type of clients are actually certain type of clients who enjoy such services are leapfrogging, and then others are left behind. That question we don't have answer. We don't know. We tend to look at how digital solutions or financial services are sort of expanding the customer base and then bring the bottoms up is our approach, but we don't look at the sort of a higher segment of the customers. What is the World Bank new digital initiative? Digital development is we changed our name of department called from, traditionally we call it ICT colleagues, but we changed digital development. We do a lot of digital economy, but also we look at how to expand government services through digital means. One example in Africa, using drones to deliver medicines, or those are another. We're looking at solutions, say medical solutions or educations, and how we can deliver such services in remote areas using technology. That's really we putting our efforts a lot, not only creating a digital economy and e-commerce. How does digital finance create more inclusion for women? I believe this study shows that the women who with the mobile phones access to digital finance are actually better off than men. And a lot of government, say social services, social conditional cash transfers, targets are women. Study shows that the women better manage finance. So with the tool that and women have a lot of ideas and entrepreneurship. We had a study in also project in Ethiopia, again that the women better off from entrepreneurship. So providing access to financial services either through mobile phones, which is an easier way and a cheaper way, is actually creating opportunities. Because women often didn't have opportunity to do business before, but now the landscape is changing, and then the ideas and the women are contributing a lot, and then with the ideas, so women entrepreneurship is really critical, and we also focusing on the gender gap between men and women. Central bank, one question is central banks' crypto coins, but there are a lot of discussion of a central bank issued digital currency. But I think the debate is not set yet. The different models of digital currency, whether the public open account at the central bank or using commercial bank. And it's a payment systems debate on how to increase in efficiency, also liquidity. But I don't have a specific opinion on this one. Most fintech services leverage the internet, but the internet infrastructure is not sufficient, not urban, rural areas. Is fintech really? So this is a good question. I think we already discussed about mobile phone coverage internet. And I think my question to the fintech community is that who are you targeting? Because when we say fintech, it's probably lack of my knowledge. The fintech can mean a lot of things. It's, as a firms providing services like Endo, using microfinance model to providing lending to the community itself, or factoring, P2P crowdfunding. But who are you targeting? And I think it's interesting to see if you are targeting people in, say, Kuala Lumpur or outside of Kuala Lumpur or cities, and the question is why, and why not remote areas, and then what is really stopping you from going in remote areas? Why you are not going to Sandakan or going to remote east part of Malaysia? Because distance is not really issue for you. But why not? I think I'd like to hear your views on this one. I think. Yes, please.
First and foremost, Endo, thank you so much for a wonderful presentation. And my apologies to you and to everyone here that I'm not a Slido. I'm a 74-year-old slider, possibly, according to my grandkids. The thing is, if I may ask a basic question, back to the first slide, one thing which is very human, and I think is perhaps to some extent hazardous in terms of the work environment. That is to say that if I may remember, your first slide talked about efficiency, wherein when you include labor, you put labor productivity. The thing is, with fintech, as I understand it, the jobs that we used to remember are going, if not gone, the manual work. How does one, if I may ask, how do you look at it as a consequence management of where do we deploy them or re-employ them? Or is it a question of basic back to education kind of thing, for the whole nation to address? If I may ask you, thank you so much. I appreciate this.
So impact of fintech or technology on the job.
It's sufficient because it creates labor productivity, enhances. When we talk of labor, we think of the human being. But with robotics, with artificial intelligence, the human being, or some of us, will have no more jobs.
Yes.
Replaced. But even a young friend of mine said, Islan, you're a lawyer. We can replace you one day.
Yes.
I hope not now. Otherwise, I couldn't feed my wife. Anyway, but the thing is, that's quite scary. We can have a lawyer who is 1,000% much better than you are because of artificial intelligence. If I may ask your view on this. Thank you so much.
Yes, thank you. No, of course that I'm not the expert on this space, so my information is at either Financial Times or those newspapers, but that I read. But interesting thing is that the Japanese banks hire, as a Japanese system, all the college graduates are hired at the same time. So April 1, they start new fiscal year. That's when the people are hired. Usually during the, so it's sort of cohort system. This year, the Japanese banks collectively hire less graduates. And then because of technology. So yes, it is true that some employees are replaced by robotics. And then I think Financial Times, I think last year, the list of jobs that can be replaced by technology. Now, I have small children. They are third grade and then first grade, and then they go to international school in Manila. But I was surprised at how they learn mathematics. And the way they teach mathematics are completely different from what I learned. I learned that the Japanese system, so I memorize to 1 times 1, 1 times 2, 1 times 3, and all these tables that I have to memorize. But they don't teach that way now. They know that the society that they are going to in 20 years from now, or maybe 15 years, are completely different from what we see. So these kids are prepared to work with numbers and more the big problems as mathematics as a tools, rather than just as memorizing formula to come up with solutions. Now, I think the point is that yes, we need to be adaptive in terms of technology development. We know certain jobs are gone, will be gone, and have already been gone. Now, but it will not replace entire system. It will not replace all of us. So creativity will still remain. That you need as the people creative. But again, we don't know where the world is heading. And I'm not, as part of the World Bank bureaucrats, I'm not the best person to answer such question. But even within the World Bank, things are changing. How we process the documents, how we use how we work, have been changing. So I think we need to, but the bottom line is that the same. In terms of communication, in terms of the quality of the individuals. And the World Bank has a project. Last year also we published the Human Development Index, which captured, in terms of health, in terms of education, to monitor the human development, human capital development. And that's also the purpose is to how the society as the government are prepared to promote human capital development for the future. And that's, I think, important. It's not really the quality of the type of work, type of jobs, but also it involves health, education system, and all other sectors that contributes to that discussion.